The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
It's hard to be bearish with economic like this, but it's hard to be bullish with political risk like that. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Mixed economic data and a wall of earnings, keeping stocks in a pretty narrow band at the moment.
Yeah, busy afternoon ahead.
Let's take a look at where stocks stand at the moment. You have the S&P 500 largely unchanged, marginally lower, but the Magnificent Seven up by 0.7%, with Google's earnings, Alphabet's earnings, that is, helping boost big tech overall. And of course, we're waiting for Microsoft and Meta this afternoon. The 2-year yield moving, ultra sensitive, of course, to Fed policy, rising as traders are reducing their bets on more easing from the Fed. Overall, we've seen this bond sell-off since, let's say, mid-September kind of fade these last 2 days. Now, gold futures, however, certainly not fading, up by another 2/3%, another record high, Romaine. We continue to watch that.
Yeah, I mean, the price action is so compelling, and obviously a lot of this does surround election risk. Now, we had at least 5 of the Mag 7 stocks on this day higher, hoping to support this market, and that's led, of course, by a monster gain in Alphabet, as that expensive foray that it did make into AI, at least based on yesterday's results, does appear to be paying off to some extent. Sell-side analysts across the board rapidly hiking their top and bottom line forecasts for the S&P 500 tech sector, and that's suggesting that there could be a fair number of beats like Alphabet's this quarter, and we're going to find out if they are right or wrong later tonight with report cards from Microsoft as well as Meta. Now, we did get a report card on the U.S. economy, and it was Dean's List material, if you will. 2.8% GDP growth in the third quarter on an inflation-adjusted basis. Consumer spending, that component, that advanced 3.7%. And then you had a separate report out this morning that showed pending home sales jumping the most in 4 years on a late summer dip in borrowing costs. That is the backdrop, and all of this has fundamental flows for the U.S. stock market, turning increasingly bullish, which should give equities a positive jolt once the bearish, or rather skittishness, around the U.S. election is out of the way. A potential coiled spring of gains, if you believe Nomura cross-asset strategist Charlie McElligott, who says the market remains overhedged for election risk, overhead for central bank risk as well, Scarlett, as overhedge on earnings risk as well.
Yeah, absolutely. And of course, let's stay on the earnings angle, because here's what is coming up in the next hour. Microsoft is seen reporting slower growth for both its top and bottom lines. It will be judged on whether its spending on AI initiatives dings its operating income and erodes margins, and whether Microsoft gives a reassuring outlook for its Azure cloud business in the second half of the fiscal year. Now, the bar is higher for Meta, given the stock's outperformance this year. Sales are seen rising 18% to more than $40 billion, and the focus is on digital ad spending and how Gen AI is helping that. Looking ahead, investors are asking if Meta's foray into VR and AR positions it as a major player in hardware. Romaine?
And of course, that's going to be a big question for Meta tonight. It was a big question yesterday for Alphabet. They did beat expectations across the board. Shares having a pretty good day today, up about 4%. Laura Martin joining us right now, senior entertainment and internet analyst at Needham Company, helping us kick you off to the close. Laura, let's start off, of course, with those results that we got out of Alphabet. There was some concern here about the amount of money that they've been spending in the AI space, but at least when you look at revenue growth as well as the bottom line numbers, there does seem to be some payoff there, right?
Yeah, 3 key takeaways from the Alphabet earnings. One is revenue up 15%, costs up 5%, so operating margins exploded, up 34%, all of being driven by generative AI. So it looks like generative AI is going to really hold down cost growth and create these operating leverage trajectories for these companies that are in the forefront of generative AI. Second, search benefited from generative AI. They said that generative AI queries, they're closing the monetization gap with traditional search, and it gets people to search more. So they're getting higher volumes and they're closing the monetization gap. A lot of people thought 2 quarters ago that ChatGPT would take search away from Alphabet. That doesn't appear to be happening. And then third, really Google made a very strong case that vertical integration between data, huge data flows coming out of search and YouTube, plus AI engineers, plus this integrated tech stack with a large language model is beneficial to them.
How does that feed into that cloud division? I mean, they are still in third place, a somewhat distant third place, but there seems to be some optimism that they can close that gap with Amazon and Microsoft.
Yeah, that was the biggest upside surprise, actually. Cloud at Google, Alphabet grew 35% on the revenue line at 17% margins. They reported $1.9 billion of operating profit. That was $1 billion more than us in consensus estimates. Like they doubled the profitability out of cloud that anybody thought they would. So very strong cloud numbers coming out of Alphabet.
So how does that set us up in terms of expectations for an Amazon, which of course does rely on its cloud business and is kind of has the first mover advantage compared to others?
Right. So it should be. I think this means it's really good for Amazon. We should see very strong cloud strength. And they have 30% operating margins in their business. So the 18% consensus number, we would expect to be higher for Amazon, and we would expect their margins to be higher than the 30%. I think it's good for AWS, which is the Amazon Cloud label. But if it's not, then what that means is that Alphabet is buying cloud share. So let's just hope that it's good for everybody and not that they're competing, that Alphabet is buying cloud share away from AWS and Microsoft.
Okay, so that's something we'll be watching for. And of course, Amazon reports results tomorrow on Thursday. But in the meantime, we have to get past Meta and Microsoft's numbers first. When it comes to Meta, I feel like the bar is much higher because the stock has done so well. Mark Zuckerberg has really crafted a convincing story for investors that its spending on AI is paying off for its digital ads and for its search business, which it's starting off. What's the specific case that he's made better than other tech executives?
So, I mean, the first thing is he's done a really good job with Threads and Reels, which are sort of knockoffs of Twitter, X, and TikTok, respectively. He's really good at fast following other people's good ideas. His revenue growth, very strong. Last quarter up 23%. We're looking for 40% operating margins this quarter. So really strong economics. What the big question on Meta is capital spending on glasses, Quest, virtual reality headphones, large language models trying to compete with Alphabet and Microsoft and Amazon, and metaverse. Like he's just got a lot of things going on in the hardware business and in the large language model. So we really want to look at his expense growth and his CapEx growth to make sure he's not hurting the returns on capital from his core business.
Is there some sense here, too, particularly, and you mentioned the glasses, they have the Ray-Ban glasses out now, and of course they previewed Orion, which at some point, in theory, next year should become available to the public. Is that something, I just feel like their track record when it comes to hardware and personal devices has been a little sketchy, and I am curious as to whether this might actually be that sort of product that I guess takes Meta to a different level. I don't know exactly where Zuckerberg's trying to lead it, but certainly something better and more lucrative than where it is right now.
You know, he said he's going to now develop search to compete with Alphabet, search. So, I mean, I think the problem with Meta is it's small compared to Amazon, Alphabet, Apple, and Microsoft. And he's trying to sort of play on the big boy porch. And the question is how much money that costs him. And can he be successful, I think, is what is it. And he's funding it through this awesome core business that has very high returns on capital and high profitability. And that's what I think Wall Street, right now, Wall Street's telling you with the stock up 70% this year, that they think he can make this transition successfully. I worry that every dollar he invests has a lower return on capital than the dollar he earned to pay for that. So we'll see. We'll see what he says today after the close.
All right, Laura, great stuff. Going to have to leave it there. Of course, Microsoft and Meta reporting after the bell tonight. Microsoft shares slightly higher on the day. Meta shares slightly lower as we continue to kick you off to the close. Stick with us. A lot more coverage coming up right here on Bloomberg.
So we touched on third quarter GDP a bit earlier. It showed the economy expanded 2.8% in the period, a touch lower than what was anticipated. For this current quarter, the Atlanta Fed's GDP now shows the economy pretty much maintaining that pace. Joining us now is Andrew Slimmon. He is Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management. Andrew, it is good to speak with you. Thanks for taking the time. In terms of economic surprises, it's kind of surprising, the extent to which we continue to outperform what economists had anticipated for different measures of economic growth. At some point, though, the switch flips, right? Because people keep revising up their estimates, and then the economy no longer is beating estimates, and it just kind of performs as expected. Why are we continuously not getting there yet?
Because we're only the second year of a bull market. We had a bad bear market in 2022, and classically, the forecasters come out of bear markets underestimating the power of the economy. At the tail end of a bull market, they are overly optimistic. So I don't think this is all that surprising. You know, I've been on your show in the past. I've been talking about this. When we talk to companies, they continue to tell us that business is stronger than what I hear from, many of the Wall Street, pundits. So I think it's consistent with the earlier stages of a bull market, not the later stages.
Okay, so if we are consistent with the earlier stages of a bull market, what do you anticipate to happen once we get past the uncertainty of the election?
Well, I think, you said that you had another person on that said the market is overhedged. Look, I'm someone who always counsels financial advisors and so forth to, take advantage of pullbacks. I'm not sure we're going to get one because you have a confluence of things that are about to occur. One is I'm hearing from listening conference calls where industrial companies are saying, hey, we think there's more projects to come once the uncertainty of the election is behind us. I'm hearing the big banks say, we think there's more investment banking business to come once the election is behind us. I'm listening to the asset management, wealth management firms saying there's a lot of cash on the sidelines. People are waiting for the election to be behind us, regardless of the outcome. That's so I think that's happening. I still think the Fed wants to cut rates, even though the economy is strong, because real rates remain high. And I think there's the world's awash in liquidity. So I could see a situation where those overheads comes off and you pull forward next year's return. We get a pretty powerful market in November, December.
And that seems to be the case that Charlie McElligott was sort of making over at Nomura, this idea that is kind of that coiled spring that, barring some huge exogenous event, is going to come undone in a positive way. I am curious, Andrew, just about your general read on corporate fundamentals. I know we're still somewhat early in the earnings season, though by the time we get to Friday, we'll have a much clearer view of how the S&P 500 companies have done. Have you been encouraged by what you've seen so far?
100%. Without a doubt. I mean, you can pick and choose the positives and negatives. What I will be watching, Romaine, and this is so important, is what happens to next year's earnings number once all the reports are in. Because ultimately that's what matters. Because when you say, well, where's the market going to end the year? Well, it's going to be priced off next year's earnings estimates. And those estimates trickled lower going into earnings season, but with so many, which is classic, companies bring down guidance a little bit so they can beat. Yeah. And so I think, will 280 be back on the table? I think $280 of S&P earnings. I think that's the important number. So I'll be watching that closely. But so far, I don't see a reason to expect that the earnings growth for next year won't be as good as what people expected going into this earnings season. And that's what's really important as you think out in terms of what's my return from 58.15 on the S&P.
Well, but as you know, too, I mean, there has been some discussion about competition for equities, the idea that there are returns out there to be had, particularly in the fixed income space, certainly in the alternative asset space, that at least over the next couple of years, some people think will rival the potential returns that you would get in the equity market. Do you find credence to that?
Sure. I think that's one of the reasons why the market's kind of, the market's up 1% this month. Is kind of run out of steam a little bit about 5,800. I think that's the reason, because with rates moving higher, they have become a little bit more competitive. However, I will take all day long a stronger economy with maybe a little higher rates, but good earnings versus a weaker economy, earnings in jeopardy, but lower rates. I think I'm comforted fundamentally that we're hearing the economy is strong and these companies are coming in and confirming it with these third quarter earnings. And really the change for me is the market, the number of times now in this short period, I've heard companies say, we think more things are going to happen after the election. So I'm surprised by the number of companies that have said that.
Yeah. So in that scenario, a stronger economy with higher real rates, are there certain styles that just don't make sense that you don't necessarily want to pursue?
Look what's happened month to date, Scarlett, from a sector standpoint. What is working? Well, tech has done well, but so has financials. Well, that's value growth. What hasn't worked? Staples, utilities, REITs. These are defensive areas that you buy if you think the economy is weakening. And I've been on this mantra for a while. You want to own some growth stocks, you want to own some value stocks, but at the end of the day, as a bull market matures, people don't want to own consumer staple stocks. They want to own stocks that they can make a lot of money and not downside protection. So what happens at the tail end of a bull market is you start to see a pickup in the underperformance. That started.
Yeah.
I think that's what you want to be underweight is the more defensive. And I think the market is confirming, what the data is saying, which is the economy's strong.
All right, Andrew, got to leave it there. Always a wonderful discussion. Andrew Slimmon, Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management, taking a look at the institutional side of the financial equation. When we come back, we're going to take a closer look at the retail side of that equation. Chen, the CEO of Nerdwallet, he's stopping by the big program next. This is The Close on Bloomberg. All right, let's take a look at Nerdwallet. Its shares having a monster day, up almost 40% right now, best day in about a year. This after the personal finance company reported revenue for the third quarter that beat estimates in a big way. Pleased to say joining us right now is the CEO of Nerdwallet, Chen, joining us from San Francisco. All right, Tim, let's get right to it. I mean, this was a big surprise for, I think, for a lot of investors based obviously on the share price reaction here. What actually changed over the last couple of quarters between what we saw last night in the earnings report and what we had seen maybe 2 quarters ago?
Yeah, thanks for having me. So we're really proud of our Q3. I think one of the biggest factors driving our success was insurance. So we're up 6x from the prior cycle peak back in the first quarter of 2021 in our insurance business. We think we've taken a lot of market share there, and there's also secular growth in the end market as premiums have been rising and consumers need to shop for that insurance once they get those higher premiums in the mail. We exceeded our revenue guidance and our NGOI guidance, our non-GAAP operating income. Revenue grew 25% year over year, and that's in spite of a pretty tough consumer credit environment. And so just really proud of the team to be able to deliver in that kind of environment.
Yeah, and it's always, and so we should just remind our viewers kind of like what you guys are doing in addition to the personal finance and educational element. Obviously, a lot of products related to insurance, related to mortgages, credit cards, and other sort of personal finance products. Give me a sense here of what type of activity we saw in some of those other areas, particularly when it comes to credit cards and mortgages. Because when I look at the insurance side of it, I think necessity. When I look at some of the other products you sell, I think of discretionary.
I think that's fair. You know, what we've been seeing since actually early 2022 is all the lenders getting incrementally more conservative on their underwriting. From 2022 through 2023, we saw increasing delinquency rates. And so that caused a lot of lenders to get more and more cautious. So underwriting is really tight. It has been for 2 years. We're starting to see the winds blow a bit in the other direction. So some of the leading indicators are there. Lenders are disciplined. Their pricing is good from their perspective. The capital markets are starting to open back up a bit post SVB. So we're having credit card issuers, for example, who were walking away from qualified borrowers a few quarters ago, come back and say, we'll take all that we can get. So that's a positive. There are still a lot of stressful areas for consumers. We're seeing a lot of people, for example, with underwater auto loans who owe more on their cars than their cars are worth. And when they're going in to trade them, they can't afford to trade their cars in.
Yeah.
We're seeing stress in the personal loans industry as well. Right now, you might have an interest-only credit card payment with your minimum payment. Moving to principal plus interest is challenging. That's a big monthly payment. So seeing a lot of stress there.
So there's a lot of specific scenarios that you just pointed out there. As you try to deepen your relationship with your users, the visitors to your website, what can you offer them to kind of address some of those issues?
So we have two growth pillars that we often talk about. The first is vertical integration, and the second one is registration and data-driven engagement. So I'm actually really excited about a few things we announced this quarter. The first one is that we acquired a mortgage broker called Next Door Lending. If my mom needed a mortgage, I would, without hesitation, send her to Doug and Jonathan over at NDL. They shop around for you. They have great customer service, and they get you great rates from the wholesalers. We also announced a product called Insurance Assist this quarter, where you can log in with your insurance credentials. We pull all your data, and then we monitor for you. Can you get a better rate somewhere else? We think that's a great consumer experience. And we also announced that we launched a Treasury bills account, which allows you to, put money in almost like a savings account and Treasury rates, which if you live in California or New York or one of those high tax states, is great because it's exempt from those taxes.
Are there any indications you see that people are ready to take money out of savings, out of money market accounts, and actually put it to work in terms of investing it in public markets or private markets?
Yeah, we have less of a read on that. I mean, I will say that we see fewer people shopping around for savings accounts now that rates are coming in. But yeah, less visibility into that.
All right, good stuff. Tim Chen, always a pleasure. Tim Chen is CEO of Nerdwallet. I think any of these websites that offer engagement opportunities and advice on how to spend your money are going to do really well in this environment where people are trying to make the most of what they do have right now.
Yeah, you would hope so. But it also gets to this idea, as you know, there are some people that when times get tough, they just put their head on the covers and hope that, things will sort of sort itself out on its own. So you're dealing with psychology as well, investor psychology, which can be a little bit more fraught on the retail side.
Yeah, you got to offer a little bit of everything to everyone.
Yeah.
For those who are spendthrifts and for those who are just...
Yeah.
All right, well, we're going to continue the discussion here in terms of how consumers are feeling, how investors are feeling, because Roger Altman is founder and senior chairman of Evercore. He's going to join us to discuss his outlook for the U.S. election and the Federal Reserve and how it all comes together. He's got a couple of thoughts on that point. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu, and we are getting ever closer to the election. It feels like it could not come soon enough at this point.
Yeah, and I mean, it's certainly so. And you see that in the price action. We've been really trying to dissect the price action we've been seeing in this market over the last couple of weeks. It really seems like a lot of people have just really moved to the sidelines. I mean, you have some people that are brave enough to place bets, whether it's in fixed income or those weird, you're not in like poly market.
Yes.
Well,
but some French guys.
Yeah, so you got the degenerate gamblers who are willing to do that. But most people, I think, are kind of waiting and seeing. We heard that from Andrew Slimmon earlier. This idea here that once we get past the election, once we know the outcome, you're going to see a lot more activity in this market, and at least in his opinion, to the upside.
Yeah, absolutely. Yeah. Although there's been plenty of upside if you look at stocks and if you look at a couple of other securities as well. So, I mean, the big picture here is Kamala Harris and Donald Trump are putting the finishing touches on their campaigns to be the next commander-in-chief. Now, with 6 days to go till Election Day, traffic at early voting sites ramping up. So, too, is that economic anxiety. A recent Ipsos poll found that Americans are spending less and saving more because of uncertainty over the election outcome and the overall U.S. economy. Here now in studio is Roger Altman, founder and senior chairman of Evercore. Roger, such a pleasure to see you.
Happy to be here, Scarlett.
Thank you. We talk about how people are maybe on the sidelines, but some aspects of the financial markets seem to be voting early as well, right? The Trump trade has been in full swing in a couple of areas for a while. The bull steepener, the weakness in the peso, gains in Bitcoin, the rally in financials. Do you see these as strategic allocations, or is this more tactical positioning as we mark time until we get an outcome?
Well, I think the bigger question is whether the Trump trade is correct in the first place. It strikes me as tactical, but it's definitely there. I mean, financial markets, if you had to say, seem to think Trump is going to win the election. I'm not so certain of that. And financial markets aren't always right, as we all know, nor are prediction markets. But that seems to be in the market right now.
In full disclosure, you've donated to the Harris campaign, so you've got your opinions on this. Companies say that they're waiting to get past the election before they make big spending or investment decisions. Do you buy this idea that consumers are also in a similar holding pattern, and that once we get this outcome, they'll unleash spending?
I don't.
No?
But for a little bit different reason than your question suggests.
Okay.
Because if you look at the GDP result even this morning, which by any objective measure was quite healthy. I know it might have been a tick below the expectation, but it was 4 years after the recovery started to be growing at 2.8%. Pretty impressive. And the consumer spending part of it was solid, just solid. So I don't see any evidence in that data this morning that consumers are holding back, including that the latest Conference Board Consumer Confidence Index, which we just saw, rose quite a bit for the first time in a while. So most signs about the consumer in terms of spending, at least the whole category of consumers, because you can talk about different categories within it, suggest that it's healthy right now. I suppose there are scenarios where it gets healthier, but right now I think it's pretty healthy. I don't see much signs of restraint.
I am curious, though, and I mean, what you're saying pretty much dovetails with what we've heard from a lot of economists as well as other prominent investors on Wall Street. There's some concern, though, that message hasn't necessarily translated down the pike to just rank and file voters, that a lot of people
that's true.
Are looking at their current situation and they're still saying, well, I'm paying more than what I paid 4 or 5 years ago, regardless of the fact that we've seen inflation slow. But the idea is that the price levels are still higher.
And this is really quite unusual. I'm getting to a certain age and I've been involved in, this is my 10th presidential campaign that I've had some role or other in.
Yeah.
And I've never seen anything like this where the economic data right now is about as good as it gets. I mean, you've got, as we just said, resilient growth.
Yeah.
Labor markets are healthy, 4.1% unemployment rate, jobs still being created, and so forth. Private investment strong, financial markets strong, and inflation cooling, very obviously, sharply cooling. And yet, the voter attitudes toward the economy are pretty negative. And I think you put your finger on it. It traces back to the first year after COVID erupted, when year and a half, prices rose a lot. I happen to think primarily on account of the pandemic and supply chain issues.
Right.
And even though inflation, as you said, is cooled almost back to the Fed's long-term 2% target, people remember, or I shouldn't say remember, people see every day in the grocery store or elsewhere that the price of milk or bacon or eggs or whatever it may be is quite a bit higher than it was 4 years ago, and they don't like it.
This has been a big criticism of the Biden administration, that they haven't articulated economic gains in the same way that, let's face it, that we saw during the Trump administration. He was willing to boast about any positive data point, and he did it to a certain degree very effectively, whether it was true or not, but it was certainly effective. I am curious this time around, and you've had experience inside the walls of government. You've worked at the Treasury on a couple of go-rounds,
yes,
I believe, here.
I have.
So you know what's going on there. And you know the criticism they're facing from rank-and-file voters. You know the criticism they're facing from investors with regards to deficit spending and the slew of Treasury issuance that we have. If you were still within those walls, I mean, what advice would you give to the current president or the new president?
Well, I think, those are two different questions.
Okay.
The new president will have to formulate, if it's Kamala Harris, her own agenda. I don't think it'll at all be the same as if Biden had a second term.
You think Kamala Harris's administration will be remarkably different from the Biden administration?
I think it will be different.
Okay.
I think Kamala Harris is a bit more of a centrist than Joe Biden. And I think she's a bit more pro-business than President Biden. And there are a series of other things that I think will make her term, if she has one, as it evolves, you'll be able to see the differences. In terms of the current administration, I think it's mostly a communications problem, in the sense that Inflation now is where you would want it to be. And the question that I don't think they were able to wrestle to the ground is, why did prices go up so much 2 years ago and 2.5 years ago? As I said, I personally think it's a pandemic, and I'm not a communications person, so people might laugh at this, but I would have tried to explain that a little better. But in any event, I don't think it was well explained and well discussed, and I think that's one of the reasons why voters are more sour on the economy than the data would suggest they should be. If you just fell out of the sky today and you'd been on Jupiter and you hadn't had any connectivity, somebody said, here's the macro data right now, growth, inflation, jobs, you'd say, wow, that's pretty impressive. People must be happy.
So, Roger, you mentioned if Kamala Harris is elected, she'd be more centrist. Is there any one of her specific more centrist proposals on the economy that you think she would be able to fulfill with a split Congress?
Well, your point about a split Congress is an important one, because no matter who the president is, and if Trump wins or Harris wins, if it is a divided Congress, it's going to be hard to pass legislation, because it always is, number one. And number two, we're in a very partisan era where, Republicans oppose what Democrats want and vice versa. So it'll be quite an art to try to get legislation passed, by the way, including getting senior officials confirmed in the first place, in a divided Congress. But on the other hand, President Biden, to his credit, got a heck of a lot of legislation passed, including some after Republicans took control of the House. And so it's possible, but you have to be very strategic as to what can win some bipartisan support. Not all that much, but some, as compared to none. Anything that you would propose that wouldn't win any bipartisan, and it wouldn't win any support from the other side, isn't going to make it if you have a divided Congress by definition.
Are you going to stay up late next Tuesday?
I am.
You are? All right.
I am. Are you?
Well, yes, I will be working that night, and I'm sure you'll be fielding a lot of calls for people looking for advice, no matter what the outcome, or maybe we don't even have an outcome. Roger, I'd love to talk to you again, but we have to leave it there. Roger Altman, founder and senior chairman of Evercore. We'll be back in a moment. This is Bloomberg. All right, let's get a view from the sell side with our top calls. And today we're focusing just on one stock, and that is Supermicro, down more than 30%. This after we learned that its auditor, Ernst & Young, has resigned. Trouble ahead? Maybe. Let's talk to Matt Bryson right now. He joins us as managing director and equity research analyst over at Wedbush. He has a neutral rating on Supermicro. Anytime your auditor steps out the door here, that's never a good sign, at least in terms of perception, Matt. When there's smoke, there's sometimes fire. Are you seeing that?
It's really hard to say. We've certainly seen this story before with Supermicro, right? Back in 2018, there was a period when they couldn't file for a prolonged period, for a prolonged time frame. I think the immediate concern right now is they missed their scheduled 10K filing. So they've got till November 15th to give the NASDAQ a plan as to how they're going to remedy that. And then even if the NASDAQ approves that plan, they have to get their 10K filed by sometime in February to stay listed. And so it becomes a race to try to get that filing done and stay listed while you don't have an auditor.
Yeah, that's a tricky situation to be in. So Supermicro says it doesn't expect all these different issues to lead to revisions in previous financial results. Does that matter, and do you believe them?
It certainly matters in terms of worst case scenario, right? Worst case scenario is you end up with some sort of accounting fraud and numbers weren't real. Again, if you go back to the last time that this happened with Supermicro, they were moving very small amounts of revenue from quarter to quarter. And so it really didn't impact financials. The problem, again, was simply when you get delisted, it does nothing good for the stock. And so I think, again, my largest concern is simply, can they get their financials filed to stay listed? There's risks beyond that, but that's kind of what I see as the most pressing point at this time.
Well, that's what I'm curious about, too. And I mean, when we talk about the scrutiny that public companies are supposed to have, this was a stock that was basically dormant up until sometime around early to mid last year, when it really just started to take off as you started to get reports about the expansions of these data center products, or orders, I should say here. Is there any sense? I mean, I know we don't know exactly what went on or if anything negative went on. It's all speculation at this point. But was there any sense when we saw that ramp up in orders that there was any reason not to believe the numbers that they were putting in front of us?
No, I don't think there was. So I mean, we saw something very unique in that generative AI showed up, and there were only a few companies out there that could provide the solutions necessary to support that new piece of demand. So it was NVIDIA on the chip side. In Supermicro, it happened to have a large project with Meta standing up very large server farms, and they were one of the few companies at that time that could provide these high-powered servers. And so I think that their ramp was real. If I think there's a problem, or if I were to guess, it's more that you have a company that is set up to support a certain amount of business. All of a sudden business explodes. And so do you not have the people and processes in place to deal with that explosion in business? Do you get some stuff wrong? I would think that's a far more likely scenario than they were, manipulating numbers.
All right, Matt, really appreciate your taking the time to speak with us. Matt Bryson, covering Supermicro. He is managing director and equity research analyst at Wedbush. He has a neutral rating on Supermicro. And, you bring up a good point about the AI servers, or the servers to push the AI business. This kind of all happened at the worst time for the company. Yeah, not the worst time for the company, and it'll be interesting to see sort of when they can give us a more formal response. But this is something that's going to take a while, as Matt said. Like I said, if you don't have an auditor, that kind of slows the process. Oh, absolutely. All right, we're going to continue to keep an eye on all those big tech names, especially with a bunch of big tech companies reporting earnings after the close. In the meantime, we're taking a look at other companies that have reported results, including those in the industrial sector, like a plane maker, Airbus. So let's turn now to another stock that we're watching, which is Airbus. The American depository receipts on Europe's largest aeronautics and space company, they're higher after reporting results. Airbus saying it'll stick with the goal to deliver about 770 aircraft this year, really underscoring its focus on ironing out some supply chain glitches that have gotten in the way. We're joined now by Guillaume Faury. He is the CEO of Airbus. Thank you so much for speaking with us, Guillaume. Welcome to Bloomberg Television and Bloomberg Radio. I think the big story here with Airbus is that it has struggled to ramp up output. And I know you've spoken a lot about the supply chain being severely degraded. Just give us a sense of what the state of your supply chain looks like right now.
So it's quite similar to what we had by the end of the previous quarter. We are limited by some bottlenecks in the supply chain, which are primarily the engines on the single-aisle family, the A320 family, but also we have issues with seats, with interiors, and to a limited extent, landing gears. Those problems are being managed. So we have difficulties month after month to execute on the ramp-up. We have a quite difficult end of the year ahead of us, the year-end rally, as we call it, as we anticipate to have more than 200 planes to deliver in the last 2 months of the year to reach the around 770, which is the guidance. So that's the environment we're in. It's a difficult one. We deploy a lot of resources of our own teams to our suppliers to be able to help. But when one of our important partners like CFM, GE, is hit by the hurricane, the Milton hurricane in the US, that has repercussion on our own ability to deliver. So that's where we are.
So where do you expect to see meaningful improvements in the supply chain over the next year? I mean, for instance, could we get a resolution on the engines in the A320?
We know that A320 is relying on two engine makers, two engines, the GTF from Pratt and the LEAP engine from CFM. They have different situations to manage. On the Pratt side, there is an ongoing recall campaign that is leading to a lot of planes of our customers being so-called AOGs on the ground because the engines need to be retrofitted. And that's a vast plan that Pratt is managing. They're on their plan. So we believe Next year and the year after, we'll see the number of AOGs going down, and we will progressively be able to have more engines for line fit for the delivery of our own planes. And when it comes to CFM, we think it's a more short-term crisis that they have to manage. They're very mobilized and focused. It will continue to impact us later this year, beginning of next year, but it should get much better by the second half of 2025 and hopefully much better later. So these are crises of different nature. We're on it. Our suppliers, CFM and Pratt, are also managing those situations, and we think that's something that is temporary.
So, Guillaume, are you comfortable now, though, given everything that you just said, with the current cost structure right now at Airbus, or do you need to make tweaks there?
You know, we were preparing for a ramp-up that was supposed to get better earlier. So we have onboarded a lot of resources. We have sized the Airbus capabilities when it comes to production, to final assembly lines for more airplanes than what we are delivering today. So we have actually more cost on our P&L than what we would need for the number of airplanes we are delivering. But the good side of it is that we have teams that have time to be trained, to be qualified, to be onboarded on their jobs. We can also deploy teams, experts to our suppliers to help easing the situation. And indeed, this is weighing on our cost on the short term, but this is to some extent the price to pay for the ramp-up that is ahead of us, which is an incredible ramp-up, because we target the rate 75 by 2027, and that's obviously unprecedented.
Talk to me about how the defense and space business folds into that. Should investors anticipate any material changes in the structure of those businesses within Airbus?
We are at the moment changing the structure of our defense and space division. We used to have an integrated division. We are transitioning to a division that will be organized around 3 product lines, and we are transferring a lot of resources that were allocated transversally to the businesses. We want more accountability, we want more agility, we want to be able to benefit from the very different dynamics that we see in air power, which is our strongest business in defense and space. This is the military aviation part, compared to space and to what we call the connected intelligence. So we are transforming the shape of defense and space to better fit the world we're living in that field.
So will this stay underneath the umbrella of Airbus, or are you willing to entertain offers for potential separation of these businesses?
So the air power is the core of what we do. Military aviation is really what we've been doing for long, and we think we're competitive in that field, so this will obviously remain. Now, when it comes to space, as we have already indicated, it's another large business of our Airbus defense and space activity that we are turning around, but we think the situation is such that it is worth looking at options for consolidation, for more strategic option on the space business, and that's something that is ongoing in a business, the space business, that is very much disrupted. When it comes to the smaller part of our connected intelligence, yes, we are willing to cooperate, to bring those businesses with others when and if this is meaningful. So we want to be, with what we are doing in defense and space, more agile in our ability to combine businesses with others, but we will continue to remain a strong player in defense, in military, and also in space, but probably in different forms when it comes to space moving forward, as we have to find solutions to this difficult business environment.
Guillaume, one thing that we haven't talked about is the strike at Boeing. It's an ongoing strike, and it's led some suppliers of Boeing to warn about being forced to consider furloughs and job cuts. And I know that Airbus and Boeing share many of the same suppliers. How are you looking at the situation at Boeing right now and thinking through what it means for Airbus down the road in 2025?
Yeah, thanks, Scarlett. It's a great question. Actually, as I said earlier, we have a challenging situation in the supply base. Actually, the situation at Boeing, including the strike, but not limited to the strike, is adding complexity and challenges for the supply chain of Boeing. Unfortunately, or fortunately, I don't know, it can be seen both ways. Part of this supply chain is also our supply chain. So we are monitoring very closely what it means for them, and we are taking preventive actions for the difficulties that they might have with Boeing to not have repercussions on our own relationship with them. But that's another area of concern that we have to manage in this current environment.
All right, Guillaume, appreciate you taking time to be with us today. We'll let you get back to work. Guillaume Faury there, he's the CEO over at Airbus, the world's largest plane maker. As we come back here to the U.S. and continue to count you down to those closing bells, we're just about 5 minutes away. Right across the screen right now for the major indices, Jess Menton, who leads our equities coverage here at Bloomberg, joining us right now here at the big desk. And a lot of focus right now on some of the big tech earnings we're going to get after the bell, including Meta and Microsoft. We should point out the Mag 7 not doing a whole lot right now. And I do wonder if that changes within the next 5 to 10 minutes.
And the Magnificent 7 hasn't done a lot since that record high on July 10th, but you still have the NASDAQ 100 only a stone's throw away from actually a record. So it's going to be interesting to see if these can follow in Alphabet's footsteps, whether or not it can push that for the NASDAQ 100 over the line. But I thought it was interesting when you're just looking at the moves in the S&P 500 over the last couple of months. So actually the S&P 500's gone, it would be through today's close, 29 sessions without a 1% move, more than that. Yeah. And that's actually the longest streak of calm since 2021. If it goes through 30 tomorrow, that would be the longest streak since 2020.
But shouldn't that be a good thing, particularly given that we keep hitting record high after record high? I know they'll slow down, so you would think that would be what people would want, right? Yeah. The slow and steady rather than just, a big pop that gets unwound, a week later.
It is. What's unusual about this, too, is you had the VIX cross back above 20 earlier today in the trading session. So normally you don't see the S&P 500 trading at records when you do see the VIX kind of popping back above that level. But even when you're looking at hedging going into next week, obviously it's a big week. We know it's election day. You have the Fed. You have 13F filings coming up pretty soon, too, corporate earnings. But a lot of it, when you're looking at hedging, it's not really on the index level. You can see it for some of the sector type levels, too, more so than on the index level. So that's something we've been focusing on the equities team.
One thing as we look at indexes turn south is that the chip makers are really under pressure. All the members of the Philadelphia Semiconductor Index are lower. Qorvo's leading the way down. And that's tied to Apple, too, which, may say something about what people anticipate for Apple's results tomorrow.
Well, actually, if you look at SERP, the function for the options implied, the implied move, one-day move, actually, for Apple tomorrow, it's only about 4%. So that's what was interesting to me. So Apple, it is around 3%. For Microsoft today, it's around 4%. And then Meta's 7%. Yeah.
That's lower than what it used to be.
It is. So,
I noticed this. I'm glad you brought this up. Thank you, Scarlett, for asking that question. Because I noticed that, too, and I kind of scratched my head. I thought that seems a little light.
So it seems as if, especially if you look over the last couple of years, because especially big tech, and Meta in particular, it's actually jumped more than 20% twice and dropped as much as 20%, 25% in the past 8 releases. So if you look at the SERP and see that 7% implied one-day move following its results, it's really not as elevated as you think, which basically tells us that investors aren't thinking the results will be maybe as bad as.
Do you have some of those Meta glasses, those Ray-Ban things?
I don't.
Our producer does.
Our producer, she walks around with these things just recording us like, serendipity.
Well, she's talking. It looks like she's talking to herself. That's what it is, right? I mean, she's wearing her glasses and talking, and we don't know to who.
In fairness, Scarlett, she actually does talk to herself, even when she doesn't have those glasses on. Ooh. But that's a whole nother show. We love you, Queenette. Jess, our thanks to Jess Menton there, helping us count you down to those closing bells. We are just about 2.5 minutes away here. And we should point out, it's kind of a half and half kind of day here with about 250 S&P stocks in the red, the other half in the green. The net effect of it all is an S&P 500 down about 0.3%. We continue to count you down to the closing bells. A full breakdown of all your market coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here, alongside Scarlett Fu, taking you through the closing bell with a global simulcast. That global simulcast starts right now with Tim Stenovic in the radio booth, Katie Greifeld in today for Carol Masser. We welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, as we set you up for a busy night of earnings.
Yeah, this is the day, this is the moment we've all been waiting for. We got Microsoft and Meta platforms coming. We also got Booking Holdings coming in just a few minutes. We got Starbucks, so we'll hear from Brian Niccol for the first time as CEO of that company, Katie. I mean, today is the day we've all been waiting for.
Yeah, I'm pretty excited to be here. Of course, a big earnings slate
Carol
ahead of us.
Had FOMO.
Yeah,
she was like, I
hope she's listening right now. But of course, yesterday didn't disappoint with Alphabet. It did disappoint with AMD. Of course, all of this raising the stakes for what we're going to hear today, especially when it comes to CapEx around AI spend.
Yeah, an embarrassment of riches in terms of the earnings that are going to come out after the bell. What's notable as well is even as we're seeing indexes turn south and deepen their losses, trading volume is 24% above the 20-day average, at least for the S&P 500.
Yeah, and it gets at this idea, too, of amount of folks that have sort of moved to the sidelines, I guess, in anticipation of the political risk around the election, and whether we see that kind of open up a little bit more once we get past next Tuesday here in the U.S. But the earnings picture, I mean, it's been supportive if we do want to see that type of move higher here. All right, let's walk you through the numbers before we get to those earnings. The Dow Jones Industrial Average down on the day by more than 70 points, or about 0.2%. The S&P 500 looks like it's going to close lower by 0.3%. The Nasdaq Composite, which had been in the green for a portion of the day, down about 0.5%. The Nasdaq 100 down 0.8%, and the Russell 2000, Tim, down 0.2%.
All right, taking a deeper look into the S&P 500 as things do settle out, kind of an even split between gainers and decliners today. As of now, 243 stocks did move higher, 259 did move to the downside.
All right, let's take a look at the sector performances here. A mix, but certainly to the downside. You have tech, the biggest sector in the S&P 500, losing 1.3% on the day. That is weakness in chip makers. Staples and utilities also down by 0.25%. Communication services, which is really Alphabet in this case, up almost 1%. Financial services and REITs also modestly higher.
Okay, as we do wait for some of these numbers to cross, let's quickly get to some of the gainers on the day today. I do want to start with one that Scarlett just mentioned.
Hey, just going to interrupt you right now. Microsoft earnings now crossing the wire here. Their fiscal first quarter revenue coming in at about $65.6 billion. We're just going to round that up to $66 billion. The street was looking for roughly 65. Revenue out of the Azure and cloud services business, ex-FX coming in at about 34% gain on a quarter-over-quarter basis, year-over-year basis, here, and that's relatively in line with estimates as well. EPS, your bottom line number, $3.30 a share. Not quite sure what the comparison is on that, but it does look like a beat on the top and bottom line, though you're seeing the market reaction here, at least for right now. Not a whole lot going on.
Yeah, up about 0.8% in the after hours. Microsoft, that is. Booking holding shares are higher, well, bouncing around a little bit. They were up 2.7%. Now they are just pretty much flat. Third quarter gross bookings coming in way above estimates at $43.4 billion. Estimates were for $41.37 billion. Third quarter room nights sold 299 million, beating estimates of 290. Third quarter revenue coming in at $8 billion. Estimates were for $7.63 billion. Shares unchanged in the after hours.
Let's also take a look at Amgen coming out with third quarter numbers. Adjusted EPS in the third quarter came in at $5.58. That is better than the estimate, which was for $5.10. Looking through it, it looks like it was on lower than estimated costs right now. You take a look at what the shares are doing, and it's not too much right now on Amgen. Of course, traders still digesting some of these numbers.
All right, I just want to go back to Microsoft for a moment because it's really the behemoth here until we get Meta. And first quarter EPS, we do have a comparable number here. $3.30, beating the consensus estimate of $3.11. And once again, that Azure and other cloud services revenue ex-FX, when you back out the FX effect, 34%. Analysts were looking for 35%. So I don't know if we call that a miss or in line. It depends how investors are feeling. Given that the stock has not done very well, maybe this is a matches kind of situation.
And that is a big deal here. And of course, that will be a big topic of conversation when we get to the conference call where they usually give their forward guidance, not included in the release. But just very quickly here, we should point out that most of their units here are posting pretty strong growth, including even in that personal computer space, a much smaller business, $13.2 billion in revenue, but that was up 17% year over year. Microsoft shares now starting to see a little bit of traction to the upside. Yeah. Meanwhile, to the downside, let's take a quick look at Roku. Those shares down 10% here in the after-hour trade here. Net revenue in the most recent quarter, relatively in line with estimates, coming in at about $1.1 billion. Street was looking for about $1.1 billion, more or less here. But the guidance here looks like it's also relatively in line as well, $1.14 billion here. And the bottom line numbers also relatively in line. Actually, here's your number here on 4Q gross profit. And this seems to be what the market is reacting to. A slight miss on those numbers, a slight miss on a fourth quarter adjusted EBITDA as well, 30 million. Street was looking for 36.2.
All right, Roku shares down about 8% in the after hours after that report. I'm looking at shares of MicroStrategy, just a leverage bet on Bitcoin, down 5% in the after hours right now. Not
Nominally.
Even worth. What'd you say?
Nominally.
Yeah, I mean, look, third quarter revenue missed estimates, but nobody really watches that because it's just a Bitcoin play.
just a Bitcoin play. Of course, it's been doing fantastically well if you hold it, though. Of course, Bitcoin doing well as well. Let's go back to Microsoft. Of course, it's interesting. Currently up about 2.4%. And the reason we care about Microsoft, obviously, the results in and of themselves important. But you think about Microsoft and the supply chain here. NVIDIA actually gets the majority of its revenue just from Microsoft, nearly 19% there. Its second biggest revenue source is Meta, of course, and we are awaiting Meta results as well.
Yeah, and of course, you talk about how it relies, it puts a lot of orders through NVIDIA. That brings up capital expenditures and the spending on those AI chips. And for the first quarter, the fiscal first quarter, Microsoft spent $14.92 billion. That was higher than what was anticipated, which was $14.55 billion. So that's going to be a big question mark in terms of what that means for margins going forward and whether that dings its operating income as well. Oh, we have another set of results, and that's from DoorDash. I'm just going to jump on that right now. DoorDash says third quarter adjusted EBITDA of $533 million, beating the consensus estimate. Revenue of $2.71 billion, also higher than anticipated. It sees the fourth quarter gross order value at $20.6 billion to $21 billion. Analysts were looking for $20.53 billion. So even those are beats by all those metrics. The stock is marginally lower right now in after-hours trading.
Meta Platforms out, shares down 4% in the third quarter. Revenue coming in line with estimates, right around $39.9 billion. EPS at $6.03, and that is a beat. Here's your guidance for the fourth quarter. Revenue, the company says, will be in the range of $45 to $48 billion. Street was looking for 46. Expenses, and this is the big one, $96 to $98 billion. It had previously seen $96 to $99. So overall, holding the line on the bottom end of that estimate, but lowering slightly on the top end of that estimate as well. The CapEx spend for the full year, $38 billion to $40 billion. Previously, it had seen $37 to $40 billion. The Street was looking for about $38 billion even. So slightly higher on the expense side, slightly higher on the revenue side. EPS relatively in line with estimates.
Yeah, Meta Platform shares down about 1.6%, bouncing around a little bit in the after hours. Hey, I'm looking at shares of Starbucks right now in the after hours, down about 0.8%. The company coming out with fourth quarter net revenue at $9.07 billion. Fourth quarter China comp sales down 14%. Fourth quarter international comp sales down 9%. Fourth quarter North America comp sales down 6%. Starbucks CEO or I should say, U.S. comp sales down 6%. We're not seeing the stock move much relative to the numbers, given that a lot of this news came out ahead of time, given that Brian Niccol took over last month, and this is his first report as CEO.
And it's interesting. We are getting more Meta headlines here. They do expect fourth quarter 2024, that tax rate to be in the low teens. This is interesting. They still see significant capital expenditures growth in 2025. Of course, the whole market focusing on this. You can see Meta shares still bouncing around, like Tim said, down about 1% right now. This is a pretty clean report, but you think about the expectations for Meta. This has really been the shining star of the Mag 7, up almost 68% on a total return basis year to date. So the bar was certainly high.
Yeah, absolutely. Here, and we talk about this idea of what Zuckerberg and company articulate a little bit later. This idea here that the AI play, the metaverse play, whatever they're calling it these days, the idea that they seem to have found a bit of better articulation of not only what they're going to have on the consumer side with regards to the glasses that they currently have out, Orion, which may drop next year, and then of course how that all folds in to their traditional ad business on the social media platform. We're going to continue a deeper dive into Meta and to Microsoft as well, but we are getting a slew of earnings, including from Robinhood. Those shares, one of the biggest decliners in the after-hours trade, down about 12.5% after the company said monthly active users in the most recent quarter missed big time. 11 million users. The Street was looking for 12.26. Revenue coming in a bit light as well at $637 million. The Street was looking for $663 million, and transaction-based revenue also coming in a little bit light as well. Same story for net deposits. That, frankly, that is the story across all of the key metrics here, Scarlett. Basically, a modest miss, but a modest miss these days gets you a big downdraft in the shares.
Yeah, very well said. Let's also jump over to cryptocurrency and take a look at Coinbase. The shares had gained ahead of the results, but we're looking at third quarter revenue of $1.13 billion, missing the consensus estimate of $1.25 billion. As As for the outlook, what it anticipates, fourth quarter subscription and services revenue will be anywhere from $505 to $580 million. Analysts were looking for $578.2 million. So that's a pretty wide range, and certainly it does encompass the estimate, but perhaps not at the rate that investors are liking, and the stock is lower in after-hours trading.
Okay, I want to take a look at Meta Platforms before we go. Again, we're going to have deeper dives both on radio and on TV on all of these companies, including Meta and Microsoft. The company forecasting revenue for the fourth quarter of $45 billion to $48 billion. The estimate was for $46.09 billion, so bang in line there. Shares down now by a little more than 1%. All right, that is going to do it for our cross-platform coverage. The earnings palooza right here on Bloomberg TV, Bloomberg Radio, YouTube, and Bloomberg Originals. We'll see you same time, same place tomorrow.
And we continue our coverage here on Bloomberg Television. Two of the biggest movers, at least two of the most important movers in the after-hours trade. That includes Microsoft. Its fiscal first quarter numbers coming in a slight beat on the revenue side, a slight beat on the bottom line as well. Meta Platforms also out with their report, a company providing guidance here that looks relatively in line with estimates, but you can see the reaction there in the shares. A tale of two cities. Joining us right now is the co-host of Bloomberg Technology, Caroline Hyde. And Caroline, let's start off with Meta, because this seems to be the one that a lot of people are focusing on, particularly when it comes to where they fit in to this AI universe.
And how much they spend on that AI universe.
$98 billion. That's just insane to me.
And that is the cost, of course, their employees, which they've been letting go of a few. But the infrastructure spend here is what the CFO is articulating. Susan Lee really going into the fact that you're going to see an acceleration in infrastructure spend. The expense growth next year, they're going to be recognizing higher growth in depreciation and operating expenses. Basically, they are spending more now, they are spending more in 2025, and that will reap rewards. We're already seeing that when you see the AI glasses, when you see the AI, Meta AI, when you're using that within Instagram and their family of apps. However, in the here and now, you've got to pay for it. And I think perhaps that's still what Mark Zuckerberg needs to articulate on the call. And what's really interesting is you've got to remember how far these shares have run up. They are up like 67% this year after almost doubling last year. They had a very high bar to continue to rise.
And that's the thing, right? Investors have kind of given Mark Zuckerberg a pass when it comes to all that spending on AI. And maybe it's because it's visible to users in the way that, like you said, you go on Instagram and it shows up, right?
If you're in the US, and only now just if you're in the EU.
Well, a lot of investors in the US are looking at them. They're like, okay, it's starting to pay off. And I mean, he's managed to craft a pretty good story to tell investors, and they're buying it right now. What's interesting is the lack of movement in the share price today. Given how much it's gone up, it's not like there was a high bar, but it's not like it had to really do very much to disappoint investors or really surprise investors.
I think it's ultimately because the numbers came relatively in line when you're looking at the revenue growth. 45 to 48 billion are where they're expecting. That comes in with a market expectation of 46. So I think as long as they met that bar, we're not going to see that much volatility in the shares. They've ultimately been proving out that the infrastructure spend has been worthwhile. As you say, the advertising technology has really been driving up. We'll want to see, also remember what was echoed from Alphabet today was the fact that the elections helped with some of the spending on advertising. Some analysts out there seeing a 1 or 2 percentage point move on the back of election spending. So we'll see whether that really helped.
I do want to stick with this idea, though, of AI, the amount of spend going into it, but also the potential rewards. And you talk about how Alphabet seemed to put its cards on the table. Investors seem to be pleased with that. Not so much with Meta. Microsoft also doing the same. We talk about the growth that we saw in the Azure business, 34% ex FX, and now the company's saying about 12 percentage points of that was directly attributable to AI.
And that keeps going up and up and up because they are trying to break out how much AI and generative AI, their deals they're spending on the likes of OpenAI are really helping sell their cloud product. And at the moment, that was what everyone was worried about in the previous quarter. The fiscal fourth quarter, the Azure growth slightly slowed. Now they're managing to reinvigorate that. Look, it's not total apples with apples because they are re-segmenting some of their accounting.
No.
Yeah. Oh, okay. That'll say for tomorrow. But we are seeing at the moment really cloud revenue, like we saw with Alphabet, vindicated with Microsoft. And I think what's interesting is what's being articulated by Satya Nadella. He's really trying to talk about new deals he is signing. People were worrying about the market share, that whether they could retain. He's saying overall they saw new growth, operating leverage. Why? Because of AI platforms.
Well,
all right, Caroline Hyde.
Given what they're about to pay him, I guess,
I mean, for a non-founder, he's got to get some It's a high-stakes business, the CEO.
Hey,
Absolutely.
congratulations to all.
Caroline Hyde,
I hate
co-host
because
of
I'm
Bloomberg
envious.
Technology. Thank you. Thanks for coming in and giving us some incident analysis there of those results. We want to get in some sell-side analysis as well and bring in Brent Thill. He's an analyst over at Jefferies for more. So, Brent, you look at what happened with Meta, they beat, but the spending guidance seems to be something that investors are not quite comfortable with in that the shares are lower in after-hours trading. They're not upset about it either because the stock is not moving by a large amount. What are you anticipating to hear from Mark Zuckerberg on the conference call that would shed more light on the spending guidance?
Yeah, I mean, look, the stock's up 67% year to date, so it was a tough bar to clear. I mean, I don't know what they could have said to have the stock go materially higher based on where they're at, and they effectively bracketed the street's guide for next quarter. And like every other tech company, capital expenditures are significantly up. The age of AI, the beginning of the curve of the adoption, this is when you spend. You don't spend after your competitors take all the share. You spend ahead of the curve. And so I don't think this is anything different than we've heard from any other tech company. Google said the same thing, significantly higher capital expenditures in 25. Meta, same thing. Let's write the script for Microsoft. They're going to say the same thing. Amazon's going to say the same thing, okay? Mm-hmm. All the hyperscalers are going to do the same thing.
I guess this is kind of a thought exercise.
Oracle's doubling their CapEx spend. So, you know, they actually brought down their operating expense spend a bit. So this is all about CapEx. And everyone says, well, why is it going to pay off? Well, look at Google. They just effectively have $22 billion of incremental backlog, and they just spent $22 billion in CapEx incrementally over the last year. Is it paying off? It is.
So
it's paying off on a lot of figures. In terms of all these use cases, that's the question.
Right.
And still have yet to see all those at this point, but we think it will pay off.
So, I mean, that is the big question that investors are grappling with. Will it pay off? But can companies disappoint investors if they don't spend as much as they perhaps intended to, or what people are, modeling out for them? I mean, are investors rewarding or punishing the FOMO mindset?
Well, right now, none of these stocks are getting punished because they're all up massively. I mean, Google's up 25% year to date, Meta's up 67, Amazon's up 27. So again, I hear the fear, but the reality is, again, we repeat this over and over. AI needs three things: capital, users, and data. And all the hyperscaler platforms have that. No one else has it. Yeah, so it's a really boring storyline. Yeah. They all benefit because of those three factors, because there are not that many companies that have that. And so right now, these companies are getting the benefit because they've done this in past cycles. People forget, Microsoft put a lot of money into Azure. No one knew what Azure was. Everyone's like, AWS is going to kill them. What happened? Azure's the entire story at Microsoft. So is there a historic track record that these companies have made the right bets and it's paid off? The answer is yes.
Yeah, and I think, in fairness, Brent, I think most investors are in your camp here. And I mean, that's evidenced by the share price reaction had prior to today. Obviously, a little bit of pullback in the after hours trade, but who knows? I mean, that's always distorted. I'm curious if you can just go look a little bit more longer term as to what the sort of the future of all of this spending ends up looking like. And particularly, is it going to be where, like a Microsoft, where they're just kind of integrating a lot of the AI benefits into existing products? Or is it going to look a little bit more like maybe what Meta's trying to do, which is to do that, but also to have something that's much more consumer-facing and much more standalone product, like those Orion glasses that they debuted a few weeks ago?
It's a combo of both, to answer your question, but a lot of this will be embedded in the experience. So you as a user, and you're one of the 3 billion people that use their platform, they log in and you get what you want. You effectively can understand what you're anticipating. It's baseball season, so when I go on to type in MLB, it probably is trying to see, hey, what happened to the two fans that got thrown out of the game last night? Yeah. What about tonight's game? Who's in the lineup? Yeah. Like, it's anticipating and giving you what you want rather than you having to search and go deep for it. For advertisers, it's going to let advertisers create campaigns easier for less money, and so. If users are there and they're getting a better experience, the advertisers are going to be there. And if the advertisers can do this faster because AI is enabling them to create these campaigns quicker, they're going to stay there versus going to the newspapers or going to TV or going somewhere else, right? Yeah. And that's what we're seeing right now in the data that we see. So yes, there'll be some cool aspects of you get your glasses, only one person in your family, it can show up. No one else is going to see this. I want to know my daughter's calling me. That's the only person I need to hear from. Yeah. So, the glass is going to have a really interesting use case. But I think that's a long ways out. I don't think that's going to have an impact in the next year or two.
All right, Brent, got to leave it there. Brent Thill over at Jefferies, taking a closer look at Meta Platforms and Microsoft. You see the share reaction, at least they're on Meta on your screen. Some other earnings crossing the wire right now. One of the biggest movers in the after-hour trade, Carvana. Shares up 17%. This after the company said 3Q EPS coming in at roughly about 68 cents a share. That is a beat. Adjusted EBITDA, roughly a beat. Revenue coming in as well as a beat, $3.7 billion. The street was looking for $3.5 billion, and the company continues to talk about the potential strength going forward here in used car sales for the full year. Scarlett, they're saying that EBITDA will be above its high end of the previous range it gave of $1 to $1.2 billion. Street was looking for roughly about 1.2, so that is good news for them. Carvana also saying it sees a sequential increase in year-over-year retail unit growth for the fourth quarter.
Yeah, lots of positives and investors rewarding the stock, pushing it up 16%. All right, on the downside, we're looking at Etsy also moving quite a bit here. And I say downside because this is a stock that has plummeted 41% year to date. So perhaps, the bar was quite low. In terms of the adjusted EPS for the quarter that ended, 45 cents, missing the average analyst estimate of 52 cents. In terms of revenue, $662 million, beating the consensus estimate. However, third quarter gross merchandise sales did miss the average analyst estimate. Nevertheless, the stock up about 11% in after-hours trading.
All right, we do want to get back to Meta. Those shares down about 3% here in the after-hours trade as we wait for the earnings conference call. But the report that we got, at least on paper, causing a little bit of concern, not so much about growth, but I guess a little bit more here about the amount of spend that they're having to do in the AI space. Of course, Zuckerberg has come out and articulated a future of artificial intelligence that includes building out several large language models, an AI assistant, and AI-powered smart glasses. That's got everybody talking. Let's see what our next guest has to say about it. Michael Pachter joining us right now, managing director over at Wedbush Securities. And Michael, I do want to start off with the glasses, if you will, and you kind of got two versions. You got the Ray-Bans, which you can go out and buy today, but of course you got this Orion product that they seem to say is going to be the next big thing once that finally does become available, I guess sometime next year. But I think as we saw with the Vision Pro and a couple other sort of headsets, they're going to need content for this thing to keep people engaged. And I'm wondering if you think they are going to have that once this thing does roll out.
Well, obviously they're working pretty hard on this with Meta. I think any gaming company that thinks that they're going to sell a lot of units will create content for them. The real question is just how many people are going to buy these. So you and I are glasses wearers. We have to get prescription, Orions, and that's a pain in the butt. Yeah. Adds for me several $100s of expense to the product. And I have to wear my glasses all the time. People who don't wear glasses, this is like 3D TV. Yeah. It's something that it sounds good until you have to put the glasses on. Then it's a pain. The reason that the virtual reality hasn't really been working is it's claustrophobic, and you're afraid you're going to run into something. The reason augmented reality works is because it's not. So, I think there's a potential, but honestly, I think games on your cell phone can be augmented reality, like Pokemon Go, and they work just fine. So I think Facebook is wrong here. I think they're barking up the wrong tree, and it's going to fail. But something fun for them to try with their several billions of dollars of capex. Yeah, well, I mean, guess when you're the 800-pound gorilla, you can shed a few pounds and not be worse for the wear. I am curious, though. I mean, because one thing that it did intrigue me, like we're showing video right now of, I think that's the Oculus or something that we're taking a look at. And the glasses were kind of a game changer for a lot of people, at least in terms of this idea that they were just glasses, right? And we can get into this whole idea of those of us who are visually challenged, that there might be some complications, but they seemed like a better prospect than trying to put a whole headset over you like a Vision Pro or the Oculus here. You can do a lot of things now with that. Do you not think that could be the selling point, Michael? No, I actually do think that glasses are natural. half the population wears them for either reading or just to see. So, sure, half the population will find these interesting. I just meant it's complicated for those of us who actually need our vision corrected. It's far more natural than a headset. And a headset, we're all claustrophobic. If you put us in a coffin or something, close the door, it freaks us out. That's what wearing a headset is like. You can't actually see where you are. And I think, there's a great risk you're going to punch your TV out when you're doing boxing. So augmented reality completely addresses that.
Yeah.
If you're used to wearing the glasses and suddenly your Google search is going on with your glasses, just thinking of something and looking up and there it is, sure, it'll work. The killer app is probably information and not gaming. Gaming is a nice to have, but we've got our phones for that. You don't actually need to put a pair of glasses on. And how do you control the game? So I actually think the cell phone makes a lot more sense for gaming than a pair of glasses.
Okay. I wonder what lessons Meta, Mark Zuckerberg can learn from, the Vision Pro Quest over at Apple, which hasn't really gained any traction, or even Oculus, which, it launched, but it never really hit the mainstream in any meaningful way.
Yeah, don't read books like Ready Player One and then go spend billions of dollars chasing a dream. I mean, that's the lesson to learn. I think Zuckerberg's dreaming, and he might be right. Elon Musk is dreaming. And I think with SpaceX and Starlink, he actually might be right. Maybe the charger network for Tesla is right. So it takes audacious people doing audacious things to have innovative breakthrough. I think Zuckerberg, unfortunately, thinks he can do that with everything. And I think he's wrong.
So when it comes to trying to make Orion into something more than, an Oculus or Vision Pro Quest, it all comes down to the content, the app developers that he partners up with. Is there one app developer or content provider that he absolutely needs to get on board, and that will kind of open the floodgates to others joining?
He needs a killer app. And so it isn't that there's a game that's the right answer as much as it is somebody's going to develop something for either Orion or for Oculus that is a breakthrough game that everybody decides they want to play. There really wasn't that game on the iPhone. There were thousands of them. And, it's changed a bit, but it's games like Candy Crush that got my wife to start playing games. It's games like Words with Friends that got your mom to start playing games. So somebody's going to come up with some innovation and come up with a game that we haven't thought of yet that will take. Yeah. And truly, augmented reality is a better format for games. So probably something will emerge.
Well, the question is, how much is that game going to cost? I feel like everyone's now pulling back on some of the game spending because they realize just how much it costs to create a blockbuster game. I mean, you just asked, what was it, Amazon, Netflix recently just abandoned that effort there?
Google pulled out completely. Yeah. Netflix shut down their AAA studio. Sony just shut down a big studio. Yeah. So, everybody's cutting back on expense. In fact, the industry is growing. Yeah. It's just shifting toward free to play. Yeah. So the killer app is probably going to be a free to play game.
Hey, Michael, just real quickly before we let you go, we only got about 30 seconds. I'm going to ask you the loaded question of the day. Who you got tonight, Dodgers or Yankees?
I live in L.A., and I really wanted the Yankees to win just because it's been so long, but history says Dodgers win it tonight.
All right,
so
there we go.
They are up 3-1, Romaine.
Another bold call by Michael Pachter.
Michael Pachter over at Wedbush, thank you so much for joining us. I'm rooting for the Yankees, of course, but I also told you that I expected them to win yesterday to avoid getting swept.
Yeah, I mean, which is good for them. I'm glad that they, finally.
You don't have a dog in this.
Yeah, I'm a Yankee hater, so I don't really care for the Dodgers either, but why not?
Did you hate watch any of this?
I did, actually. I watched it early, and then when I saw the Dodgers were kind of falling behind, I was like, oh, okay. I mean, they were up for the first couple. And then that guy, those two goons who tried to rip the ball out of the hand,
no, they're
banned for tonight.
They're banned, okay.
I think they should be banned
who's
forever.
not banned? Our producer, Meredith, who's going to be attending the game.
She is.
All right, coming up, we're sticking with earnings. We're going to break down Starbucks, Booking Holdings, and eBay next. This is Bloomberg. All right, hugely busy afternoon of earnings. We've got a wave of them. Let's get you a roundup of some of the notable movers and bring in Bloomberg's Jess Menton, Isabel Lee, and Alexandra Semenova to help us out. Jess, let's start with you on Starbucks.
Well, it's pumpkin spice latte season, but unfortunately that hasn't been helping Starbucks, especially in the third quarter. So it actually was a contraction again for revenue for the third straight quarter. Also, if you're looking at comparable store sales, they actually fell 7%. So that was its steepest drop since the pandemic. If you look at stock, though, down 1% in after hours trading. If you look at the SERP function, though, in the terminal, the options implied a one-day move there, was around 5%. Also, I have to point out, we did get the preliminary results earlier this month, so investors were well aware of what Starbucks was going to report. But the big thing is on the earnings call, especially coming up after the closing bell here, is Brian Niccol. Of course, he famously left Chipotle in late August to take over the helm here when it comes to Starbucks. So investors want to know exactly how they're going to change the company, because the company actually pulled its guidance for 2025 just because of everything going on. So they want to know more indications of how this company, and especially Brian Niccol, is going to turn the company around here. But moving over and looking at travel stocks, I know that it's something that Isabel's looking at very closely.
Indeed, I am. I'm looking at Booking Holdings, which is the parent of travel brands like Kayak and Priceline, reporting room nights booked for the third quarter that beat analyst estimates. So evidently, this is a sign that consumer demand didn't really slow down as much as analysts were expecting. You see shares up as much as 3.4%. Earlier, it was even higher, close to 5%. So room nights booked surged 8%. This is higher than Wall Street estimates and also higher than the company's projections. We also have gross travel bookings, also higher than expected. And adjusted EPS was at 83.89. Investors were expecting 77.27. So again, this is welcome news, because we have online giants like Airbnb, Booking, Expedia, really expecting softer consumer outlook. That's as consumers, they say, change their behavior. So this includes booking for lower rate hotels or even shortening their trips overall. We have shares of Booking rising around 25% year to date. They're beating their rivals. And at 4:30, which is around any time now, we're going to have their earnings call, in which they will also offer their financial forecast. What are you looking at, Alex?
Hey, Isabel, I'm taking a look at eBay. A miss on its outlook, sending shares tumbling in after-hours trading here. Net revenue forecast came in at $10.29 billion. That is below Wall Street estimates of $10.32 billion. A key metric for the company, also gross merchandise volume, coming in below estimates for the third quarter. Now, the stock is just taking it on the chin here in after-hours trading, down about 10% right now. It fell as much as 21% when those results first came out. Now, the company has been focusing on a narrow category such as car parts, collectible items, luxury goods, in an effort to stem eroding market share. It, of course, has been facing intense competition from companies like Amazon, Temu, Walmart also. And that strategy has boded well for eBay up until now. The stock was up about 44% year to date going into this report. Now, this is a situation where investor expectations were simply just too high. Morgan Stanley analysts said that the earnings setup was very difficult going into this report. However, they think that the long-term prospects for eBay look good, and they're positive on their growth trends. Guys.
All right, Alex Semenova, Isabella Lee, and Jess Menton there. A closer look at some of the earnings. A couple more that we have our eyes on. That includes shares of Carvana, which continue to be dominant here in the after-hours trade, up 19%. We talk about a company that had been struggling with growth for more than a year and a half, now putting together 3 straight quarters of revenue growth, not to mention the profitability underpinning that. And then you have Clorox, a bit of a turnaround story there as well. Of course, this was a company that got hit hard by that cyber attack. It really sapped sales. They now have returned to that pre-cyber attack sales growth level, and you see that reflected in the shares, up 2%.
But I wonder how much excitement there's going to be for a consumer staple name in this current environment.
Yeah.
Roger Altman talking about how, the economy doing well. I think it was Andrew Slimmon as well over at Morgan Stanley. When the economy is doing well, you don't necessarily want to be in these safety plays. Yeah. All right, I'm also looking at MGM. You can see it's down about 6.5%. Lower sales, lower than expected sales and profit because of a slowdown in Las Vegas betting. There were record numbers over at Macau, but that was still below analyst estimates. And Coinbase losing about 3%. It turned profitable and revenue doubled versus last year, but it still missed estimates. And revenue, at least compared to the second quarter, fell about 18% as crypto prices largely went sideways in the quarter.
All right. We just, of course, we're talking about the earnings that we got out of Meta and Microsoft, two of the highest weighted companies in the S&P 500. Tomorrow, we get the granddaddy of them all. That is Apple, set to report tomorrow afternoon, giving the first look at how its new iPhone 16, its smartwatches, and its AirPods are selling. Bloomberg's Mark Gurman covers all things Apple for us, and he joins us right now to talk a little bit more about what to expect tomorrow. Is tomorrow going to be all about the iPhone? Is it going to be more about some of these AI products? What are we expecting to hear, Mark?
I'm setting my over-under on Apple Intelligence and AI mentions at 15. during the conference call. I think they're going to talk a lot about these new AI features. Apple knows that some consumers want these features, but they know everyone on Wall Street wants to hear about them. And I think that was a big driving force behind this Apple Intelligence push this year. Even when products are updated and the prior version of that product supported Apple Intelligence, they're calling these products as the ones built for Apple Intelligence, right? So they're really going all in on this in terms of their marketing. And we're going to see, are consumers believing the AI hype? Is that going to lead to strong iPhone 16 sales? And we're going to get a glimpse of that. We had about a week and a half of iPhone 16 sales, new AirPods and Apple Watch sales in the fourth quarter that ended on September 30th, being announced on Thursday. We won't know more until the end of January or early February when they announce their holiday quarter results. But we're going to get some color here. And on the last earnings call, the third quarter one, Apple said that they expect revenue to grow about 5%. I don't expect them to veer from that. I don't think they're going to miss on that. I don't think that Luca Maestri, the CFO, this call tomorrow is probably going to be his last as CFO at Apple, unless something catastrophic happens. Yep. Right? The new CFO is supposed to start after the turn of the calendar, and I don't think he wants to report a miss on his last call. So I think they're going to find every penny and dime under the couch they can to get over that $94 billion that Wall Street is looking for.
Yeah, well, he wants to go out on a high, like you put it. In terms of the new iPhone 16, yes, that will be kind of the way to read what kind of demand there is for Apple Intelligence. But do the new smartwatches and the new AirPods also offer that same capability? Is there a read-through for those items?
I think the wearable story right now at Apple is extraordinarily incremental. The changes that you saw with the Series 10 watch this year, from an engineering standpoint, they are quite significant. But from a pure visual standpoint, which is what ultimately sells these new products, I don't think this is something that got the market extraordinarily exciting. Personally, I think the new AirPods 4 line, you now have a $130 model that looks like the AirPods Pro. So basically, many of the Pro features at half the price. I think that's a pretty good model, but I think it's going to take time for those to get into the channel and be something that gets scooped up by Apple customers. The early adopters, as we know, they're the ones pushing for the new Pro level devices, right? The pricier devices. So I think these new AirPods 4, well, absolutely terrific and a big step forward for the AirPods line. First of all, they're not something that are a gigantic revenue driver. Yep. Two, these are models that you're going to see their performance over time rather in this smaller window.
All right, great stuff. Mark Gurman, Bloomberg's authoritative voice here on all things Apple, especially when it comes to new gear. Let's stick with Apple here and bring in Erik Woodring. He is Executive Director of Technology Hardware Equity Research at Morgan Stanley, to give us a little bit more analysis on what we can expect. And Erik, I wanted to ask you about Qorvo. It's a chip device company, and its biggest customer is Apple, and it plummeted in regular trading today, and a lot of the Apple suppliers also fell in tandem. How much is that a hint of what we can get from Apple?
Sure. Well, thank you for having me on today. It's great to be with you guys. I do think there is some read-through to Apple. You know, I wouldn't isolate this conversation to Qorvo. Amcor is another stock that reported yesterday. Somewhat similar read-through, which is there might be some share shifts within each of these companies, and there might be some timing nuances between when Apple ordered components this year versus past years. But generally speaking, you can look at these stocks and what they're saying, and they're not telling you that seasonality is above expectations. They're not beating and raising necessarily. So they're not telling us things are better than we expect. If anything, right, they're being a bit more cautious. Yeah. It's hard to be a perfect read-through, but again, directionally, they are more cautious read-throughs than positive read-throughs.
But when you look at we've been through this cycle. I feel like every couple quarters we get through this period where people start speculating about softness in iPhone sales, softness in that, and the idea that somehow Apple is somehow going away. And of course, they always manage to prove that, look, they have an ecosystem. And I want you to talk a little bit more about that ecosystem, particularly the opportunity to try to leverage that with some of these AI tools. And I know they just came out, 24, 48 hours ago. But the idea that could that potentially be a driver, not just to bring in new users, but to better monetize the existing ecosystem?
Sure. So just to quickly address, your first point, which is, I've said for the December quarter, I think Apple will report something like $125 billion. Consensus today is about $127.5 billion. I'm 2 cents below consensus in the December quarter. We talk all about the number of iPhones that they're going to ship in the December quarter, but at the end of the day, the numbers aren't going to change significantly, to your point. They're not going away. I don't think this is going to be a very volatile report, even though it is previewing the all-important holiday quarter. To the second point that you're making about the ecosystem, right, that is the key to this story, right? The more products you own, the more products you buy, the more products you spend. And today, we still estimate that the average Apple user spends about $1 per day on all of the hardware and services that they buy. Compare that to a cup of coffee, compare that to your utility bill, compare that to a tank of gas, whatever you want to compare it to that's more of a utility, it is extremely low. So not only do I say that because there's reasons for why I can argue for more user growth, but there's plenty of reasons why I can argue that the ecosystem is strong, but spend per user still has a ton of upside relative to where we are today. So at the end of the day, for Apple, the ecosystem remains the key. And I don't think that changes as we look forward, especially with Apple Intelligence permeating across more than the iPhone, right? We talk a lot about how Apple Intelligence could impact the iPhone 16 and subsequent models.
Sure.
Well, you're also going to use Apple Intelligence on your iPad, on your Mac. Eventually, it will permeate things like your Vision or your Vision Pro AR, VR glasses, whatever the next generation is called. And so Apple Intelligence is very much going to be an ecosystem play, even if just today we maybe talk more about it relative to the iPhone than anything else.
Fair enough, fair enough. What are you anticipating when it comes to what Apple will reveal about China and its prospects there? I mean, it's faced a lot of competition from Chinese handset makers.
Sure. Frankly, for China, what worries me a little bit more is just the general macroeconomic conditions in China rather than competition. That's not to say that it's not a competitive market. It is probably Apple's most competitive market. But the macroeconomy is still very challenging in China. And although we've gotten maybe unprecedented stimulus, it takes a while to flow down through to the consumer. And so as it relates to the September quarter, right, we will get an update on China for the September quarter. The year-over-year compare gets 10 points easier than the June quarter.
Okay.
And we know that Apple had relative success selling an iPhone 15 discounted in China in the September quarter. So I actually think that the China growth rate in the September quarter will be surprisingly good. We just have to realize that number can be very volatile based on comps, based on what's changing. December might not look as great as September, but at least what we know in September, I think will probably surprise positively.
All right, we're going to check back in with you to see whether that comes to fruition. Morgan Stanley's Erik Woodring giving us a nice preview there of the earnings expected out of Apple tomorrow after the bell. Meanwhile, here on this Wednesday afternoon, we're taking a closer look at Meta and Microsoft.
And you can tell the shares are not moving a whole lot in after-hours trading. We're still waiting for the earnings call to get started. And really, I think what's going to drive share price movement is the color that they offer in terms of the kinds of ways that they're spending and how they're spending and how they see that playing out.
And this gets to some comments I think that Brent Thill was making a little bit earlier in the program, the idea that the numbers themselves, meaning the CapEx spend and what they're returning on that, at least in the here and now, aren't as important as that longer term narrative.
Absolutely.
And really telling a story, which is really what tech companies are all about.
Yeah, Mark Zuckerberg has done a pretty good job of it so far, given the outperformance.
I'm really interested to see what he wears as well. Because, I mean, he's kind of gotten a cooler look now. He's got the cooler shirt, the cooler
Maybe
haircut,
he'll wear the Orion,
the gold
too.
chain and everything else. Yeah, he's like hip.
This is The Close on Bloomberg.
Keep our eyes on earnings, and right now keeping our eyes on Ventas, the second largest owner of senior housing communities in the U.S., just reporting 3Q results. Top line number on the revenue side up about 7.5%, and funds from operation on a per share basis normalized at 80 cents versus 75 cents year over year, and slightly above street estimates of 79 cents coming into this report. I'm pleased to say that the chairperson and CEO of Ventas joins us right now, Debra Cafaro. Debra, great to have you here on the program. And we talk about some of the long-term structural changes in our society and how companies like yours has the potential to benefit. For those folks who aren't familiar, this is more than just nursing homes here. We're talking about a real estate portfolio that really spans a lot of areas of medical services.
Yes, thanks for having me on, Romaine. We're pleased to announce good earnings and an increase in guidance at Ventas. We are a very large participant in the longevity economy. We have about $40 billion in assets that serve a large and growing aging population with incredible secular demand trends. And we are very excited to report good earnings today as part of a multi-year growth story that we have driven by senior housing.
I am curious about your customer base and the idea that a lot of this revenue is basically coming out of their pocket. You don't necessarily have the reimbursements from the federal government and other things that helps to facilitate a lot of what we see in this space here. How consistent and reliable is that stream of revenue?
Yes. Well, senior living offers an incredible value proposition to residents and their families. It is a consumer-driven choice, and we have enormous demand at the doorstep, which is really fueling 9 quarters of double-digit net operating income growth. Anyone who's ever had a loved one who needs support knows how valuable it is to have a setting where seniors can be cared for, they can live with dignity, they can live longer and healthier lives, and the worry kind of goes away. And so that is really what these communities offer to seniors and their families. So the demand is strong and getting stronger as we see the over 80 population growing by an expected 27% over the next 5 years. Far and away the fastest growing segment of the U.S. population.
Right. I mean, the demographics really determine a lot of what you're talking about here. In terms of geographic areas where you are seeing the most growth and the most potential, is it also in places that are warmer, for instance, the Sun Belt, places like Florida, like Texas, where they've seen a lot more population growth than, say, the Northeast?
Yes, great question. I mean, Ventas is across the U.S. and in the U.K. and Canada. Principally, though, the senior housing business in the U.S., we see demand across the board. We see it in the Northeast. We obviously see it in the Sun Belt and in other areas. And a lot of what we do in acquiring assets and managing our portfolio is to make sure that we are in the right markets where we have high levels of over 80 population, high levels of senior population growth, and very low supply, so that we have that favorable backdrop into our business.
Debra, your communities are, as you mentioned, private pay. They encompass independent living, assisted living, and memory care communities. Can you tell us a little bit about what you think that will look like in 5 years' time? Because it's changed so much over the past decade and 2 decades that I think people who don't have loved ones who are in these communities may not fully understand what the future looks like.
Yes, and that is really an important point that you make. Senior living itself offers a real buffet of services that are customized to what a senior may need. In the independent living communities, which are a great product, they're very apartment-like with lots of independence, as the name would suggest, and they provide socialization and meals. And there's a cohort of seniors for whom that's an ideal setting in which to live in their over 80s. And then others, of course, need more care. And those are the assisted living and memory care communities where there is additional needed care and assistance with tasks of daily living. And that's obviously customized to a different cohort of the population. We really try to serve this population across the board and meet the seniors and their families where they are and with the needs that they have.
Debra, I do have to ask you, about a year ago, you were dealing with a few activist investors circling around, including over at Lit. And I am curious as to whether that has been settled or whether you are anticipating him to actually re-up some of the concerns he had about the performance of the stock and board representation.
Well, with the momentum that Ventas has right now and the stock price performance of 60% over the last year, as well as the momentum we have, we've announced $1.7 billion of senior housing investments year to date, which we're very excited about. So we're growing organically, we're growing externally, and there was a settlement. So we're very focused on driving shareholder value, as we always have been, and that's our principal motivation.
All right, I'm going to have to leave it there. Really appreciate you taking time to be with us today. Debra Cafaro is the chair and CEO over at Ventas. The share is unchanged here in the after-hours session, up 38%, though, on a year-to-date basis. A lot more coming up here on the big program, including some of the market-moving events happening over the next 24 hours. This is The Close on Bloomberg. An incredibly busy day for earnings, and tomorrow is not going to be a whole lot different. We get a bunch of earnings coming out tomorrow before the bell, and that includes Merck and Estee Lauder.
Yeah, Merck, which is developing a weight loss drug but doesn't have one on the market yet. Estee Lauder has a new CEO, so I'm sure that'll be part of the talking points.
Yeah, Kellanova, Uber, MasterCard, Comcast, all before the bell, and then tomorrow after the bell, Scarlett, going to be really busy again.
Yeah, it's all about Apple and what it says about the iPhone 16 and Apple Intelligence. I mean, they don't have a whole lot of time period to cover, but it'll be a good indication of what they expect going forward.
Amazon also scheduled to report, as is Intel, two compelling stories that could potentially drive the market when you get back on Friday. But before we get there, we also get some economic data. Challenger job cut, 7 a.m.
Yeah, Challenger job cuts kind of setting the tone for, again, the jobs report on Friday. But at 8:30 a.m., we get jobless claims, which will be much more scrutinized.
We also get that PCE price index report. This is the monthly one, and that includes the personal income and spending numbers.
Yep. And then in the evening, tonight.
In the evening, later tonight, I'm told there is a big game coming up.
It's
apparently, are you going to this game?
I'm not, but our producer is.
Okay, well, good luck to our
Meredith.
producer, and good luck to the Dodgers. This is Bloomberg.
Dodgers?